Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Weighted Average Cost of Capital Explained, a complete guide. The formula applies weights to reflect how much each source, equity or debt, contributes to total capital. This approach ensures WACC provides an accurate average cost of funding. Example calculation of WACC. Offer a real-world example or hypothetical case showing how to calculate WACC. Let's break down a hypothetical example to see WACC in action. Scenario: Company XYZ needs to calculate its WACC. Here are the details. Market value of equity, E, $500 million. Market value of debt, D, $200 million. Cost of equity, RE, 10%. Cost of debt, ROD, 5%. Corporate tax rate, TC, 25%. Step 1. Calculate total value, V. Add equity and debt together. V equals E plus D equals $500 million plus $200 million equals $700 million. Step 2. Find the weights, E, V and D, V. E, V equals $500 million per $700 million equals 0.714, 71.4%. D, V equals $200 million per $700 million equals 0.286, 28.6%. Step 3. Adjust the cost of debt for taxes. The after-tax cost of debt is ROD times 1 TC equals 5% times 10.25 equals 3.75%. Step 4. Plug values into the formula. Now, combine all the inputs. WACC equals E, V times RE, plus D, V times ROD times 1 TC. WACC equals 0.714 times 10%, plus 0.286 times 3.75%. WACC equals 7.14% plus 1.07% equals 8.21%. Final answer. The WACC for company XYZ is 8.21%. This means the company needs to earn at least 8.21% on its investments to cover its financing costs. If investments generate more than 8.21%, the company creates value. If they fall below, the company is likely losing money on those projects. Factors influencing WACC. The weighted average cost of capital, WACC, depends on several factors, both internal and external. Businesses must monitor these to keep their funding costs under control. This section covers 3 key influences: market conditions, company risk profile, and tax implications. Market conditions. Explain how economic conditions influence WACC. Economic conditions can significantly change a company's WACC. Why? Because shifts in the market directly affect the cost of debt and equity. When markets are stable, borrowing costs are often lower, and investors are more confident, which reduces equity costs. But in times of uncertainty or recession, risk increases, and so do interest rates and equity return demands. For example, interest rates. When central banks raise interest rates, borrowing becomes more expensive, driving up the cost of debt. A higher cost of debt means a higher WACC. Investor sentiment. During economic downturns, investors demand higher returns to offset the increased risk. This pushes up the cost of equity. Inflation. Rising inflation reduces the purchasing power of future returns, causing lenders and investors to demand higher compensation, which raises WACC. A company operating in a shaky market will likely face higher financing costs. It's like running against the wind. It takes more effort and cost to move forward. Company risk profile. Discuss how a company's risk level impacts its WACC. A company's risk profile plays a huge role in determining its WACC. Investors and lenders assess risk to decide what return or interest rate they require. If a business is seen as risky, these costs will climb. Here's how risks come into play. Creditworthiness. Companies with low credit ratings or a history of missed payments are charged higher interest rates. For them, debt becomes costly, driving up WACC. Business stability. Established companies in predictable industries often have lower risks, resulting in cheaper equity and debt costs. Startups or firms in volatile sectors see the opposite. They're expected to offer higher returns to attract funding. Leverage. Businesses with high debt levels are seen as riskier, as they may struggle to pay back loans during tough times. This limits their ability to borrow cheaply. Managing your risk profile is like maintaining your credit score. The better it looks, the lower your costs. Tax implications. Detail how taxes affect the cost of debt and overall WACC. Corporate taxes have a direct impact on WACC, especially through the cost of debt. Why? Because interest payments on debt are tax deductible. This deduction reduces the after-tax cost of debt, making borrowing less expensive. Here are the basics. Tax shield. The tax benefit of deducting interest payments lowers the effective cost of debt. For example, if a company has a 25% tax rate and pays 6% interest, the after-tax cost of debt drops to 4.5%. Policy changes. Changes in corporate tax rates directly alter this tax shield. A lower tax rate reduces the shield, leading to a higher debt cost, and potentially a higher WACC. International considerations. Companies operating globally must account for varying tax rates across regions. Differences in tax law can influence total WACC. The tax effect acts like a discount on borrowing costs, but changes in laws can quickly impact a company's bottom line. WACC and investment decisions. Weighted average cost of capital, WACC, is more than just a financial formula. It's a decision-making tool that guides businesses on where and how to allocate resources. By understanding WACC, companies can determine whether an investment makes sense and whether it will create value. Below, we explore two critical ways WACC is applied in investment strategies. Using WACC as a discount rate. Explain how WACC is used in discounted cash flow, DCF, analysis. When companies evaluate investments, they need a way to compare the money they'll spend today with the cash they might earn in the future. That's where discounted cash flow, DCF, analysis comes into play, and WACC is at its core. WACC serves as the discount rate in DCF analysis, which adjusts future cash flows to reflect their present value. Why does this matter? Because a dollar earned 5 years from now isn't worth as much as a dollar earned today. WACC accounts for the time value of money and the risks involved with a particular project. Here's how businesses use WACC in DCF. Estimate future cash flows. Companies project the money they expect to earn from an investment over its lifetime. Discount those cash flows. By applying WACC as the discount rate, they calculate the present value of those future earnings. Compare to initial investment. If the present value of future benefits exceeds the cost of the investment, it's worth pursuing. Think of WACC like the hurdle an investment needs to clear. If the returns don't beat WACC, the project may destroy value instead of creating it. In this context, a lower WACC makes it easier for investments to succeed, while a higher WACC sets a steeper challenge. For investors and decision-makers, this clarity is invaluable. WACC in capital budgeting. Discuss how WACC impacts capital budgeting decisions. Capital budgeting is essentially a company's to-do list of potential projects, like expanding into new markets, buying equipment, or launching products. WACC plays a starring role in deciding which of these projects gets the green light and which gets shelved. Here's how it impacts the process: setting the benchmark. WACC helps businesses establish the minimum acceptable return for any investment. If a project's expected return doesn't meet this benchmark, it's usually not pursued. Prioritizing projects. When companies have multiple opportunities, they rank them by profitability. WACC serves as the yardstick for comparing the net present value, NPV, of each option. Projects with higher NPVs relative to WACC are seen as better investments. Managing risks and resources. Companies with a high WACC must be more selective since their financing is expensive. This often results in cutting lower yield projects to focus on those with higher returns. On the flip side, a lower WACC gives businesses more flexibility to pursue growth. Picture WACC as the compass that points businesses toward value-adding opportunities. Without it, navigating through risks and returns would be like trying to steer a ship without a map. For every investment decision, WACC ensures the company is making informed and financially sound choices. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.